When people think about losing money, they picture a bad stock pick or a failed business venture. Maybe they imagine watching their savings account dwindle during tough times. But what happened in 1929 wasn't just about losing money. It was about watching an entire economic reality collapse in real time. 89% of wealth simply vanished, not lost to bad decisions or market corrections, but erased as if it had never existed at all. And the terrifying part is that it didn't happen overnight. It followed a precise pattern, a sequence of stages that built momentum like an avalanche gathering speed down a mountainside. The crash of 1929 wasn't an accident. It was the inevitable result of a system that had been pushed beyond its breaking point through 7 distinct stages of economic destruction. Each stage fed into the next, creating a cascade of failure that would reshape America for generations. And here's what should keep you awake at night. That same pattern is unfolding again today. Stage by stage, exactly as it did nearly a century ago. America is now deep into stage 5, and if history is any guide, we're running out of time to change course. Let me show you how this works, because once you understand the pattern, you'll see it everywhere. In the headlines, in the policies, in the desperate measures governments take when they think no one is watching. The stages aren't just economic theory, they're a blueprint for collapse that repeats with mechanical precision whenever societies make the same fundamental mistakes. Stage 1 begins with what economists call the credit expansion phase. This is where the trap is set, though it feels like prosperity at the time. Credit becomes cheap and abundant. Banks compete to lend money to anyone with a pulse. Investment flows into every corner of the economy, inflating prices and creating the illusion of sustainable growth. In the 1920s, this stage was powered by innovations in consumer credit and the rise of installment buying. Suddenly, ordinary Americans could purchase automobiles, radios, and household appliances on payment plans. The economy seemed to be entering a new era of permanent prosperity. But beneath the surface, something dangerous was happening. The expansion wasn't built on genuine productivity gains or increased savings. It was built on debt. Families borrowed against future income they hoped to earn. Businesses leveraged themselves to expand operations and chase higher returns. The financial system itself became dependent on ever-increasing levels of borrowing to function. What looked like economic vitality was actually a slow-motion crisis in the making. Every dollar borrowed today would eventually need to be repaid with interest tomorrow, and the mathematics of compound growth meant the burden would only get heavier over time. The key indicator of stage 1 is that debt grows faster than the underlying economy. This creates the illusion of growth while actually weakening the foundation. In the 1920s, total credit outstanding grew at nearly twice the rate of actual economic output. Banks convinced themselves this was sustainable because asset prices were rising, providing collateral for even more loans. It was a self-reinforcing cycle that felt unstoppable to those inside it. Stage 2 arrives when speculation takes over from genuine investment. Credit that was originally used for productive purposes gets redirected into financial gambling. Stock markets become casinos where ordinary citizens place bets on companies they know nothing about, convinced that prices can only go up. The media celebrates every new high as proof that old rules no longer apply. Experts proclaim that traditional measures of value are outdated, that this time really is different. In 1929, this stage was marked by the explosion of margin buying. Investors could purchase stocks with as little as 10% down, borrowing the rest from their brokers. This leverage amplified both gains and losses, but in the euphoric atmosphere of the late 1920s, no one worried about the downside. Stories spread of shoeshine boys and taxi drivers making fortunes in the market. Investment pools manipulated stock prices with impunity, creating artificial demand that sucked in even more speculators. The Radio Corporation of America became the poster child for this madness, with its stock price rising 61 points in just 4 days on pure manipulation, before crashing back down and wiping out thousands of investors. The danger of stage 2 isn't just the speculation itself. It's that speculation becomes so profitable that it draws resources away from productive activities. Why build factories or invest in research when you can make more money trading pieces of paper? The economy begins to hollow out as capital flows toward financial engineering instead of real value creation. Society starts to reward financial manipulation over productive work, creating perverse incentives that accelerate the coming collapse. Stage 3 is where the wealth concentration reaches extreme levels. The spoils of the credit boom and speculative mania don't flow evenly through society. They accumulate among a small elite who have the connections, resources, and inside information to profit from the system. Inequality reaches levels that would have been unthinkable just a generation earlier. The top 10% of Americans controlled roughly 84% of household wealth by 1929, a concentration that hadn't been seen before and wouldn't be seen again until today. This concentration creates a dangerous dynamic. The wealthy elite, flush with paper profits, begin to believe their own propaganda about permanent prosperity. They increase their leverage, convinced that asset prices will continue rising forever. Meanwhile, the bottom 90% of society sees their real purchasing power stagnate or decline, even as the overall economy appears to be booming. Consumer spending, the engine of economic growth, becomes dependent on borrowing rather than rising wages. Families go into debt to maintain their standard of living while the wealthy accumulate ever larger shares of the nation's assets. The political implications are enormous. A small group of financiers gains disproportionate influence over policy, using their wealth to shape regulations in their favor. The financial system becomes designed to benefit insiders at the expense of everyone else. Complex financial instruments proliferate, creating opacity that allows manipulation to flourish. The average citizen loses the ability to understand, much less control, the economic forces shaping their lives. Stage 4 brings the first cracks in the facade. Asset prices become so disconnected from underlying fundamentals that even modest selling pressure can trigger sharp declines. Volatility increases as markets swing between euphoria and panic. The smart money begins to quietly exit positions, leaving smaller investors holding increasingly worthless assets. Credit starts to tighten as lenders realize they've been too aggressive in their lending practices. In 1929, this stage began in the summer before the October crash. Stock prices became increasingly erratic, with sharp rallies followed by equally sharp declines. Trading volumes spiked as nervous investors tried to time their exits. The financial press began to publish warnings about excessive speculation, though these were largely ignored by a public still drunk on easy profits. Behind the scenes, sophisticated investors were already reducing their exposure, sensing that the party was nearly over. The most dangerous aspect of Stage 4 is that it looks like a temporary correction rather than the beginning of systemic collapse. Markets recover from their initial declines, creating false hope that the worst is over. This draws in even more speculative money as investors try to buy the dip. The temporary recoveries actually make the eventual crash worse by increasing the total amount of leveraged money in the system. Credit conditions begin to deteriorate during this stage, but slowly at first. Banks become more selective in their lending, but they don't want to admit that many of their existing loans are already impaired. The financial system develops internal stresses that aren't immediately visible to outside observers. Liquidity becomes increasingly concentrated among major financial institutions, leaving smaller players vulnerable to any disruption in funding markets. Stage 5 is where we find ourselves today in America. This is the stage where the contradictions of the previous phases become impossible to ignore. Debt levels reach the point where they can no longer be serviced through normal economic growth. The government becomes the borrower of last resort, taking on private sector debts to prevent immediate collapse. Interest payments consume an ever larger share of tax revenues, crowding out spending on infrastructure, education, and other productive investments. The numbers tell the story with brutal clarity. America's national debt now exceeds 120% of gross domestic product, a level that historically has marked the beginning of sovereign debt crises. Annual interest payments on this debt are approaching $1 trillion, consuming roughly 20% of all federal revenue. For every $4 the government collects in taxes, $1 goes directly to bondholders without providing any current benefit to citizens. But the real danger isn't just the size of the debt. It's the fact that the entire financial system has become dependent on the government's ability to borrow unlimited amounts at artificially low interest rates. Banks hold trillions of dollars in government bonds. Pension funds rely on Treasury securities to meet their obligations to retirees. The Federal Reserve has created money out of thin air to purchase government debt, distorting markets and creating asset bubbles throughout the economy. This creates what economists call a debt trap. The government cannot allow interest rates to rise to market levels because it would bankrupt the Treasury, but keeping rates artificially low creates inflation and distorts investment decisions throughout the economy. The system becomes increasingly unstable as policymakers try to thread the needle between insolvency and hyperinflation. Stage 5 is characterized by desperate attempts to maintain the illusion of normalcy while the underlying structure continues to deteriorate. Governments resort to increasingly creative accounting methods to hide the true extent of their financial problems. Central banks intervene directly in markets to prevent natural price discovery. The gap between official statistics and lived experience grows wider as authorities massage data to support their narratives. This is where we are today. The question isn't whether the remaining stages will unfold. The question is how quickly they'll arrive and how severe the final collapse will be when it comes. Collapse will be when it comes. The warning signs are everywhere if you know how to read them. Corporate earnings reports filled with accounting tricks that would make Enron blush. Regional banks quietly tightening lending standards while publicly claiming everything is fine. Pension funds desperately chasing yield in increasingly risky investments because treasury bonds can't cover their obligations to retirees. The financial press celebrates every small uptick in economic data while ignoring the structural problems that grow larger each day. What makes Stage 5 particularly insidious is that it can persist for years, even decades, before the final reckoning arrives. Japan has been trapped in a version of this stage since the 1990s, using monetary manipulation and government spending to paper over fundamental economic weaknesses. But America faces a unique challenge that Japan never confronted. The dollar's status as the world's reserve currency means that when the American system finally breaks, it will take the global economy down with it. The parallels to 1929 become unmistakable once you understand what to look for. Wealth concentration has returned to levels not seen since the eve of the Great Depression. The richest 1% of Americans now control more wealth than the bottom 50% combined. This isn't just a moral problem. It's an economic time bomb waiting to explode. When wealth becomes this concentrated, consumer spending patterns become dangerously dependent on asset price bubbles. The wealthy spend based on how rich they feel, not how much they earn from productive work. If stock markets or real estate values decline, they cut back dramatically on purchases. The middle class, meanwhile, has been forced to maintain their standard of living through debt, just as they did in the 1920s. Credit card balances, student loans, and mortgages have reached levels that would have been unthinkable to previous generations. The most frightening aspect of Stage 5 is how normalized the abnormal has become. Interest rates near 0% were once considered emergency measures deployed only during severe crises. Now they're treated as the natural state of affairs. Central bank balance sheets that expanded by trillions of dollars during the 2008 financial crisis never contracted back to normal levels. Instead, they've continued growing, creating dependencies throughout the financial system that make any return to normalcy impossible. This is the trap that no policymaker wants to acknowledge publicly. The economy has become addicted to artificial stimulus in the same way that a drug addict becomes dependent on ever higher doses to function. Withdrawal from these policies would trigger immediate economic pain, but continuing them guarantees an even more devastating crash later. Politicians choose the path of least resistance, kicking the can down the road while the underlying problems compound. Stage 6 begins when the government loses control of its own debt dynamics. This is the point where borrowing costs start to rise despite central bank intervention. Bond markets begin to demand real returns that reflect actual risk, rather than accepting the artificially suppressed rates that have prevailed for years. The mathematics of compound interest, which worked in the government's favor during the expansion phase, now work against it with devastating force. In 1929, this stage arrived when the Federal Reserve finally tried to cool down the speculative bubble by raising interest rates. The action was too little, too late. The debt structure had become so fragile that even modest tightening triggered a cascade of defaults. Margin calls forced leveraged investors to sell assets at fire sale prices, driving markets lower and triggering even more margin calls. The spiral became self-reinforcing as each wave of selling created the conditions for the next wave. Today, the trigger could be inflation finally breaking free from central bank control, forcing interest rates higher despite policymakers' desperate attempts to keep them low. It could be a foreign government deciding to dump its treasury bond holdings, overwhelming the Federal Reserve's ability to maintain artificial demand. It could be a major bank failure that exposes the true extent of hidden losses throughout the financial system. Whatever the specific catalyst, Stage 6 is characterized by the sudden realization that the emperor has no clothes. All the financial engineering, accounting gimmicks, and monetary manipulation can't change the fundamental fact that too much debt has been accumulated relative to the economy's ability to service it. The choice becomes stark: either default on the debt or debase the currency to make it payable in worthless money. The speed of this transition can be breathtaking. Modern financial markets move at electronic speeds, allowing panic to spread around the globe in minutes rather than days. High-frequency trading algorithms can amplify selling pressure, creating flash crashes that would have been impossible in 1929. The interconnectedness of global finance means that a crisis starting in one country can instantly metastasize throughout the world financial system.